The stock market just hit another all-time high. AI valuations are soaring, everyone's debating whether we're in a bubble, but while you were watching those headlines, $2.5 trillion just vanished from the Federal Reserve's balance sheet, and almost nobody noticed. I'm going to show you why that disappearing money reveals something far more dangerous than any PE ratio or valuation metric you've been watching. Right now, every investor is looking at the same things. Tesla trading at almost 200 times earnings. The Buffett indicator around 220%, the highest level in recorded history. Tech making up more of the S&P 500 than at the peak of the dot-com bubble. And look, those numbers matter, but they're not the story. Here's what institutions understand that retail investors are missing. Those metrics tell you the market is expensive. They don't tell you what happens when it tips. And here's where it gets interesting. There's a number that most people have never heard of called overnight reverse repurchase agreements, or reverse repos. This is how the Federal Reserve controls liquidity in the financial system. Think of it as the cushion between the market and a hard fall. In 2023, that cushion was $2.5 trillion. Banks were parking money at the Fed, earning a safe 4% return. That money was sitting on the sidelines. It was the emergency brake. Today, that number is basically zero. Virtually all of it, almost every single dollar, has left the Federal Reserve and flooded into the economy. Most of it ended up in the bond market and the stock market, which explains why stocks kept climbing even as the Fed raised rates. But here's what most people miss. That money leaving the Fed doesn't just mean more money in stocks, it means the safety net is gone, the cushion disappeared. And when you understand what happens when that cushion vanishes while the market is sitting on borrowed money, you start to see the pattern that shows up before every major crash. Let me show you the actual math that determines whether we get a normal correction or a generational wipeout. Because every crash in history, and I mean every single one, comes down to two components that multiply against each other. Component number one, the leverage ratio. This is how much borrowed money is in the market compared to the size of the economy. Right now, margin debt, money borrowed to buy stocks, is sitting at $1.2 trillion. That's 3.7% of GDP. That number matters because when investors borrow money to buy stocks, they amplify their returns. If you have $1,000 and the market goes up 10%, you make $100. But if you borrow another $9,000 and invest $10,000, that same 10% move makes you $1,000. Leverage turns 10% gains into 100% gains. But here's the real magic, it also turns 10% losses into 100% losses. And here's what people don't realize. When the market drops and your losses hit a certain threshold, your broker doesn't ask if you want to sell. They force you out, it's called a margin call. Either deposit more cash or we're closing your position. Let's look at what this looked like historically. In 1929, right before the Great Depression, margin debt hit 2.6% of GDP. The market crashed 89%. In 2000, before the dot-com bust, leverage was at 2.5% of GDP. The Nasdaq dropped 78%. In 2007, before the housing crisis, we were at 2.5% of GDP. The market fell over 50%. But here's where it all starts to click. In 2021, leverage peaked at 4% of GDP, the highest ratio in modern history. Everyone expected a catastrophic crash, but the market only dropped 20%. Why? That's where component number two comes in. Component number two, the liquidity cushion. Liquidity is the available cash in the system. When the market drops, leveraged investors need cash fast to avoid margin calls. If liquidity is high, they can borrow against their stocks, deposit that cash, and wait for the market to recover. The crash stays contained. But if liquidity is tight, they can't get that cash. Positions get liquidated. One forced sale triggers the next. And here's what most people miss. That's when a 10% drop becomes a 50% crash. But here's what changes everything, and 2021 is the perfect example. Leverage was at an all-time high of 4% of GDP. But the Federal Reserve had just injected trillions into the economy during COVID. Liquidity was everywhere. So even with record leverage, the crash stopped at 20%. The cushion absorbed the fall. But here's where it gets interesting. Look at 1929. Leverage was only 2.6% of GDP, lower than today. But the US was on the gold standard. You couldn't just create more liquidity, the cushion didn't exist. Result, an 89% crash and the Great Depression. The dot-com bubble, leverage at 2.5%, liquidity tight, 78% drop. 2008, leverage at 2.5%, but liquidity froze when banks stopped trusting each other. 50% crash. Here's what institutions understand. The crash formula isn't about how high the market goes, it's about leverage times liquidity. High leverage with high liquidity, you get a correction. High leverage with no liquidity, you get a wipeout. And now look at today's numbers. Leverage at 3.7% of GDP, near 2021 record levels. But those reverse repos, the Fed's liquidity cushion, basically zero, gone. All that money already left the safety of the Fed and entered the market. And here's what's hiding in plain sight. When reverse repos hit zero, it means banks pulled every available dollar out of the Fed to lend it into the economy. They're making more money lending than parking cash. But it also means there's no backup plan. The emergency fund is empty. In October, the Fed had to inject $29 billion directly into the market to prevent a liquidity crisis. In December, another $13.5 billion. That's not normal. That's the Fed stepping in because the cushion disappeared and the system started to crack. So we have two things happening at once. Leverage near record highs at 3.7% of GDP, and liquidity at the lowest level since the Fed started this program. Both components locked in place. And here's what most people miss about this setup. In past crashes, you could see leverage building and watch liquidity tighten. You had time, but this time, the liquidity vanished while everyone was distracted by AI valuations and Nvidia's stock price. The money left the Fed, and retail investors never looked at the chart. So what happens next? Let me show you the 3 inflection points that play out when leverage meets zero liquidity. Inflection point 1. The crack. Something breaks. It doesn't have to be big. In 1929, it was overvalued utility stocks. In 2000, it was unprofitable internet companies. In 2008, it was subprime mortgages. The trigger changes, but the setup is always the same. A small drop in an overleveraged market. Inflection point 2. The margin call cascade. Leveraged positions start getting liquidated. Investors can't get cash because liquidity is tight. Forced selling drives prices lower. Lower prices trigger more margin calls, more liquidation, more selling. The 10% drop becomes 20%, then 30%. Inflection point 3. The freeze. At some point, buyers disappear. Nobody wants to catch a falling knife. Liquidity doesn't just tighten, it vanishes. That's when the market goes into free fall. That's when 30% becomes 50% or 80%. Here's where we are right now. We're not quite at inflection point 1 yet. The crack hasn't happened, but both components are in place. The leverage spring is coiled, the liquidity cushion is gone. All we're waiting for is the trigger. You'll never hear this on the news, but Warren Buffett is sitting on over $300 billion in cash, the largest cash position in Berkshire Hathaway's history. He sees the same numbers you just saw. He knows what happens when leverage meets no liquidity. So here's your memorable phrase: the cushion is gone, the spring is coiled. What should you do? Don't try to time the exact moment. But understand this, when that crack happens, liquidity will vanish fast. So here's your to-do list. Have cash ready, so when the crash occurs, you can go bargain hunting. If you are at 5% cash, consider upping it to 10 or 15%. Have a plan. Because when leverage meets zero liquidity, the market doesn't give you time to think. Decide now what sectors you want to target and start compiling a watch list of particular stocks. In market downturns, sectors that provide essential goods and services that are in constant demand regardless of the economic climate tend to perform well. Consumer staples, healthcare, utilities. Other sectors that may hold up include discount retail, financial services, and precious metals. Finally, don't panic. As you see what looks like cracks beginning to form, consider rotating out of, or at least reducing exposure to, high beta assets if you have them. Missing out on a little upside is better than holding the bag when the market starts dropping like a stone. What Wall Street's not telling you is the setup is complete. Both components are in place. Now you know what almost everyone else is missing. If you found this perspective valuable, hit subscribe. It really helps the channel. We publish fresh content several times a week to help you understand the economy and protect and grow your wealth, and keep the momentum going. Watch Why the Stock Market Hasn't Crashed Yet, What They Don't Want You to Know. It's on the screen. Click it, and I'll see you there. If you want to get your financial house in order, I've put some links in the description that may help. Check it out. Remember, none of this is personal financial advice. It's education so you can build your own plan. Thanks for watching. See you on the next one.